You have undoubtedly seen articles referencing a trillion. Folks, that's not with a B, that's with a T, $1 trillion in multifamily debt that is coming due over the next couple of years that in theory needs to be refinanced. And as you've been watching my daily financial news, you know that is becoming increasingly difficult. We're going to have this conversation with the one and only Mr. Jonathan Twomley, who is in this space, has done deals in this space, and it's going to get interesting. Jonathan, what do you see out there? What's going on?
Yeah, so the big topic of conversation in the multifamily space right now is this overhang of $1 trillion of debt that's coming due over the next 3 years, I believe. So it's all of the 2021, 2022 vintage debt that's on 5-year notes. There's about $1 billion of this stuff outstanding. And there's kind of like a perfect storm developing here because that is all the debt that, was created at the height of the bubble, where people were buying properties at ridiculous valuations or refinancing properties and pulling money out at crazy valuations. And just on the expectation that interest rates would still be low 5 years later and that they would just be able to refinance and roll the debt over, no problem. There's a couple of things that have so if you first of all take, purchase at the high, right? So inflating the amount of debt out there because the valuations were inflated, even as compared to 2019, 2020, right? Because the real bubble developed when the Fed dropped interest rates low. And just as an aside, interest rates had been low for a very long time, but the Fed dropped them even lower, right? So, and it was in response to COVID. So the market went crazy, but people honestly should have been looking at this as saying, this is a one-time deal. Like, this is not a permanent ratcheting down. This is in response to a specific event. And when the event is over, interest rates are going to go back up, regardless of inflation or whatever, right? They should have understood that, but they decided not to, right? So there's a lot of people who did not underwrite their exit at a higher cap rate or a higher level of debt at a higher interest rate. They just were like guns a-blazing, full steam ahead. So that's the setup, right? Since then, what has happened? Well, everyone knows about the interest rates going up. That has caused values to go down. That has caused, your obligation, your debt service coverage ratio when you refinance to rise, right? And at the same time, insurance is up everywhere, but especially in the states that got the most attention, which were Texas and Florida. And taxes are way up, especially in places like Texas, where they have a very sort of mechanical tax, just 3% of value, and you're done. Makes it's nice because it makes it very easy to figure out what it is. You're not a lot of guesswork, but when your property value goes up, and as much as property values has gone up, taxes have gone up. So what is the net effect of all this? The net effect of all this is, as this debt is coming due, interest rates are higher and NOI is lower. And that is a very, very bad situation to be trying to refinance into. In addition to which, we've talked before about the fact that you refinance on a refi, you don't get 75 or 80%. You typically get 70%, right? Correct. So if your property has lost value in those 5 years, which likely it has, because across the board, multifamily is down anywhere between 15 to 25%, depending on who you listen to. That means that 70% of proceeds that you can get, everyone was assuming it was going to be based on a higher valuation so you can cover your outstanding debt. Now it's going to be based on a lower valuation, and there is going to be a lot of wailing and gnashing of teeth, shall we say.
Yeah, well, I think the story is kind of exactly opposite of single family homes. And let me paint the picture that I see. So again, I've always said the Fed broke housing. And one of the things that you brought up and I brought up is it's not only purchases, right? I would argue that the purchases done in 2020, 21, 22, the market could consume those. Just like single family homes, it was all the refinancing. In the single family home world, you obviously refinanced into a 30-year note. So you're fixed, your payment is fixed. Unfortunately, what we saw again in multifamily, and it's frankly why you and I sold, is a lot of financial engineering came in with wild assumptions in a very, very easy lending environment. So you had people doing, I don't know, 3-4 year value adds that recycled their capital and gave all the equity back in 1 year or 18 months or, ahead of plan.
Sure.
That brought in more people doing financial engineering, and they all felt like they couldn't do any wrong. I believe, without any data, with complete no data, that if the banks or the multifamily had to just deal with brand new purchases, it'd be painful, but you could get through it. It's all the refis. Just this, I mean, you and I saw it on social media. Everybody was refining, returning capital, just that, the other. It was a big old party. And it's the refi game that's going to end up. I mean, there'll be people that have owned assets for a while that give them back to the bank.
Yeah.
And
If they,
people don't realize what's coming.
If they weren't smart about refining, right? If they got greedy, I mean, my personal preference, if I'm looking at a deal that I have to refi, frankly, I just want to refi out the note, and that's it, right? I know investors are always like, we want cash back, we want cash out, we want to de-risk the deal. I mean, it depends on what you consider.
What's your definition? Yeah.
Yeah, of risky, right? Getting your money back out. Well, I guess that's de-risking it in a sense, but you're just adding more risk to the deal itself. So any sort of future money you've got is at risk or at greater risk. So you have to be really judicious about that, about the environment, and really have a good handle on where you think things are going to be going in the next 5 years when you refinance, right? But there's a bigger issue here. So we set the stage with like understanding how it's going to be a difficult refinancing environment. Or for difficult mathematically for individual property owners to refinance their debt. That's probably a better, sort of paraphrase of what I said. That, though, is only part of the problem, because the other part of the problem is going to be, what is the bank's appetite going to be to refinance, right?
Bingo. We talked about this at your event in Vegas, and people don't understand. I think I shared it with you 6 months ago. One of my lenders in my yearly review, which you have to do as an owner of commercial stuff, took me aside after we were done and said, "You see that file over there? I can't refi half those, right? I don't care who the operator is. I have to decline those because my bank needs cash." Now, he didn't use those exact words, but that's what he was doing. People have no idea. You think you have a great reputation. You've never done this, never done that. They can't refi everything.
Yeah, I mean, that's even a separate issue, right? So there is the banks having to rebalance across asset classes. That's one thing, but there just may simply be the pendulum may swing in the opposite direction if there starts to be foreclosures and the banks start to view multifamily as a risky asset, or at least as a risky asset for now, right? So, which they will. I mean, the minute that we've had a few high profile foreclosures and some high profile people in the news, but we haven't really had like a wave of failed refinancings, a wave of foreclosures yet, right? We've had a couple of high profile people who got really sideways on their deals because they couldn't execute their value add, and then with all the cost changes, now they're not even making their debt service right now. That's not what we're talking about, because most people are making their debt service now, right? Because they've had good rent growth, they executed their value add, right? Even if they're in a situation where they had floating debt and now they're at the top of a rate cap and they don't have a lot of excess cash, they're still making their debt service, right? The problem, though, is that when they go to refinance, what happens then, right? And what you're going to see is a lot of properties that just can't get refinanced because the bank appetite is not there, right? Putting aside issues of rebalancing and whatnot. And so then I think you're going to wind up with, listen, a lot of stuff, if you've got like Fannie and Freddie debt, for instance, you'll
okay.
probably be able to get a loan. I mean, assuming you may have a cash in refi, right? I mean, you still may be
Yeah,
doing a cash in
that's,
refi.
I'm glad you brought that up, because I think that is going to be the term of the year in 2024, cash in refi.
Yeah.
I don't think LPs are ready for it.
But I think a lot of debt that is not eligible for Fannie and Freddie, right, they're going to be in a tough spot if you've got bank debt, right?
I
And
agree.
there's going to be, the private lenders will come in, but they're going to be lending at very high rates of interest. And, it's going to be just really difficult, I think. However, so there's going to be a lot of deals that are sold, like forced sales, and that's going to drive the market down further, right? So it's going to be kind of a real, I think, a real correction coming when that starts to happen. The stronger assets, where the lenders think, okay, this is just, the operator's good, they just got unlucky, we know that they can work their way out of this. Those people will get the extend and pretend, right?
Right.
But the weaker operators and the weaker banks, and all those situations are going to wind up not being able to refinance, and it's going to be really difficult. And then as LPs get hit with the loss of their capital, a lot of them are going to exit the market, if not permanently, for a long time. So that's going to just mean less demand for apartments. So if you've been on the sidelines all this while, right, or even if not just on the sidelines, let's say, so now the bubble is gone, right? Buying now is, as you mentioned before, new deals is a different matter, right? If you're buying now, you're just in a much better long-term safety position than you were last year or 2 years ago, right? Much more comfortable buying deals now than I was then, because a big portion of the correction has happened. And I would go and do 10-year debt, and just ride out
longest
whatever
as
happens.
possible. Yeah.
Long as it's possible, right? And this is just back to kind of where we were when I started in this business, right?
No, I got to tell you, the fact that you and I were warning about this a years ago, we were early. I would much rather be early than late. But our time is coming, and it's really interesting because, again, I sort of see this as, I don't know if an analogy, maybe it's water in a line. The pressure is going to be building.
Yeah.
And we're going to see little breaks at different time. If there's really $1 trillion coming due over the next 3 to 5 years, the point of maximum pain is probably this time next year. Now, again, individual assets, individual markets, you got to, if you're there, track your market. But collectively, I think this gets pretty bad. And I don't know if you've seen what's going on with Billionaire Barry, but Billionaire Barry, I think, is executing a plan that a lot of real estate people are doing. So if Billionaire Barry Sternlicht, Starwood, I've talked about him a couple of times because, again, he goes on CNBC as a billionaire with PowerPoint, which I think is hilarious. I think a couple of weeks ago we talked. He just sold off 1,900 homes, got $450 million in cash. I think what Billionaire Barry is doing is stacking cash where he can. He has already created a portfolio that says, I'm going to keep those. I'm going to risk losing those, but I'm going to sell everything I can to stack cash. So what is Billionaire Barry doing in the last 24 hours? He's potentially selling debt on a mall at 70 cents on the dollar.
Wow.
He is stacking. Dude, he's selling everything that's not nailed down to stack cash. There's a lot of pain. And I think he's under a huge amount of pain.
Yeah. I mean, I agree with you. And I think we're going to see a lot of this. And, one of the ways, the sort of directions I wanted to take this conversation, actually, I'm sorry I was a little distracted because I was looking for something to show you.
That's okay.
But what's going on right now? What happened in 2021, 2022, and what's going on now is something that it's like the effect of something I used to talk about a lot. I used to talk about market psychology, but I made my own phrase up. The psychology part of the cycle is psychocycle, right? Mm-hmm. And what you have essentially is, when there is a perception that something is safe, everybody rushes into it, and then they make it unsafe, right?
Agreed.
Right. So that they don't understand. It's like, what is it? The Heidegger's principle with
Something
the
like
observer changes the phenomenon by observing it. It's sort of like the same thing. It's like everybody perceiving something to be unsafe or to be safe makes it unsafe, and vice versa, right? So everybody thought multifamily was the safest. After the great financial crisis, multifamily rebounded really well. Everybody thought that like, here's the safe thing to do. Everybody rushed into it. The market cycle went on for a long time, and as the Fed just kept on keeping interest rates low, it created a lot of complacency in the market. And as people started making money fast because they were,
Yeah.
that's
the thing. It's the quick money that gets more people coming in. That's the thing that made me run away. That's the thing that made me sell my stuff. It's like, this can't be real.
In a way they kind of had to, though. Like, that strategy was forced on. It's just, I love markets because it's just so interesting. Like, the strategy of having to do a quick sale, like a quick rehab, quick sale, right? Focusing on IRR rather than on absolute returns, right? That strategy was forced upon individual players in the market by everybody collectively jumping into the market, right? Because when you have a market where cap rates are higher, right, you hold longer, right? You're buying for cash flow, you're holding for cash flow. You just let the market take its course, and rent growth over time gives you appreciation, right? But when you're going in at extremely low cap rates, then there's no cash flow on the deal. All the value is on the back end when you sell, and you want to sell quickly because you can't tell investors, oh, I'm going to give you all this cash flow. All you can tell them is, I'm going to get your money back really fast and give you this IRR. IRR, frankly, as far as I'm concerned, it's like, this is a metric that like hedge funds and private equity funds should be using, insurance companies, whatever, like big institutions should be using this, right? But for your individual investor, IRR, you can't eat IRR. Like, individual investors want cash, right? They want cash flow. They can't, and IRR is meaningless. It's this number that just, it's a reflection of how fast you get your money back, but they don't want their money back, right? They want the money working for them. They don't want the money coming back to them and having to find another deal or having to worry about a 1031 or all this other kind of stuff, right? And you just got a compound problem on top of problem on top of problem at really low interest rates and low cap rates. Works great for institutions, but not so much for individuals, right? But all the individual LPs got trained to be looking at IRR rather than their cash flow, what cash they're putting in their pocket month after month. And when you're out there like selling people on financial freedom to get them into deals, to my mind, that's like, you are going to keep on building this portfolio that's going to pay you cash every month so that then you don't have to work anymore and you're free. It doesn't work if you turn around and you're just churning people's money over and over and over again. They're never going to get to that point where there's cash flow. And then, then you run the risk also of eventually you run into a correction, and then you lose, you get got. You get got. Then all that equity you've built up, can vanish overnight. And if you're lucky, the deal is long term. You got a 10-year note. It goes down, it comes up, but it's all in paper, and you don't care because you've got cash flow. The problem is when you buy at the top of the market and then you can't refinance and you're not getting cash flow, those things are all connected. Then, you had a great gain on paper, and then you have a great, actual loss, right? So that's where this has gone, and it's just sort of an illustration of what I've been talking about. And if you I know we're kind of running a little behind here, but I just do want to show this one slide. If you let me share the screen. Yeah,
I think I gave you.
Okay, so give me a second. Let me share. So this is from my course. One of the things I talk about. I have a whole lecture on what I call market psychology, right? But this is just, I think, what a lot of people don't understand, right? When the market is going from the recovery phase into the expansion phase, right, towards the top of the market, which is identified by number 11 here, right? Cap rates are falling and prices are rising. People perceive this as being less risky, but this is actually more risky. The higher up you go, look where you're going. You're going to the edge of the cliff, right? but on the ride up, everybody's making money, everybody's recycling capital, everybody is, and the higher up you go, the faster it gets, right? The faster people are recycling money. So everyone's looking around and saying, oh boy, this is the next best thing. I better get in on it, right? But what they don't realize is that it's riskier and riskier and riskier. And on top of it, the retail investors, where are they getting into this market? They're not getting in down here at 1, 2, 3, 4, 5, or even 6. The retail
8,
investors,
9, 10.
The retail investors are getting here at 8, 9, and 10.
Yeah.
When they see all these people around them making money, right? And that's when they jump in. And then what happens, of course, you could predict this, is then you get this. And cap rates are falling, and prices are falling, cap rates are rising, but the risk is actually falling too. And so the further down you go, and if you start buying down here, even if you're buying up here, if you've got long-term debt fixed, if you've got long-term fixed rate debt, you're probably going to be happy that you bought, because the next cycle will be somewhere up here around where, where I'm standing up here. Right. So this is the opposite of what the retail investor thinks. The retail investor sees prices declining and they say, oh my God, it's risky, I better get out. Right. And so, whereas what they really should be doing is rubbing their hands together with glee, thinking about how good it's getting and how they just missed all the risk. Right. So, I'll stop it here, but.
No, I think that's exactly right. And again, I want people to realize we're talking about a lot of pain coming, $1 trillion in debt. A lot of people are going to take losses. But if you follow what Jonathan and I talk about, do the work, you've been stacking cash, the opportunities that are coming could frankly make the deals that I bought in 2010 look like I overpaid. The deals that are coming are going to be that good in the multifamily space. Jonathan, where can people find you?
Yeah, well, you can reach me lots of places. One is my Facebook group, Apartment Investors Club. You can also get on my email list by going to apartmentinvestorsclub.com and getting our free download there. You can, if you like what you see here on screen, you can actually get this course. So contact me about how you can get that course as well. And if you're interested in investing with me, Google Two Bridges Asset Management, and you'll be able to find the investor link right there.
Thank you so much.